So if the market's saying the rates are going to come down by the end of the year, I mean, the 10-year is way down compared to where it was several months ago. With
well, here and this, in the inverted logic of the Fed, a Fed chair that's optimistic about the economy is going to keep interest rates high. So you almost want a Fed chair that's a little more pessimistic, because then they'll lower rates to maybe where they need to go, instead of thinking, oh no, I got to keep cooling this off,
Yeah.
But there's varied opinions, I guess, in the whole FOMC, and it's not just Jerome Powell.
It's true. It's not just Jerome Powell. It's every economist not really sure. So now this, if you're watching on the YouTubes, we got a chart pulled up. If you're on a podcast, we'll describe it for you. But Matt, we've got a blue line here. It's a Fed funds rate. That's what the Fed is actually moving around and changing. That's what they changed on Wednesday. Moved it to 5% to 5.25%. With that red line is the yield of the 10-year Treasury. Now we see it. We're going back to 1955. Long way down after the big spike in the late, really mid 80s. But now just zooming in a little bit, Matt, kind of the last, I guess this time period, we saw, interest rates, continually rise after the great financial crisis, especially the Fed funds rate. While the 10-year was kind of stable, in kind of that, high, low twos all the way, really to 3%.
Yeah.
Dropped down to as low as, 4.49, I think, basis points in the pandemic, when the Fed funds rate was dropped to 0. And it stayed at 0 for quite some time. Now, you see in this chart, Matt, the red line, the 10-year Treasury, even while the Fed funds rate was 0, the 10-year started moving up.
Yeah. The
10-year is, it's called the risk-free rate. It's one of the most widely, traded and purchased securities and bonds anywhere. Super stable, 10 years. It's a good maturity. It's a good length in time.
Seems pretty forward thinking.
Yeah, sure.
Well, I mean, if you look at this,
but exactly to your point, exactly. Yeah. It's the we're getting market information where the Fed funds rate is completely influenced by the Federal Reserve. They're keeping it down. The 10-year, which can be manipulated by the Federal Reserve and any large investor, much more driven by market forces. And so, it led the way before. I mean, you could see this. It had already moved. It had made its move considerably before.
Because people were thinking that the federal funds rate would go up?
Yeah, because everyone was seeing incredibly high inflation. And we remember this in 2021. Transient, it was like, transient, it's going to go away.
What that meant.
We learned what that. Now it's sticky. Now it's well anchored.
Yeah. That's good.
But let's look with the 10-year. It went up and it went down. Just as people had different opinions on where things were going to go. But now we've seen a trend on the 10-year Treasury with with market participants forecasting that rates are going to come down. Now, is the bond market always right? No. It's known as the smart money. It certainly can be wrong. But, this is lower lows and lower highs, which typically, if you're thinking from a technical analysis standpoint, which I'm certainly not like a technician of sorts, but I know what it is. And again, this is a trend downward. And we see, obviously, the Fed funds rate, we've gone from 75 basis point increases to 50, 25. And the narrative right now, or consensus, depending on how the data comes out, is we're going to take a pause at the June meeting and plateau this thing and see how it affects the economy over the next, many months. Because it takes a long time. It takes a long time for monetary policy to squeak into the system. We're just now starting to reset some of these rates that started increasing around this time last year. And we know it's not until later this year, really Q4, we'll start to see some movement in Q3 in anticipation, but it's not until Q4 where so many of these loans start to reset. And we'll really feel the effects of the monetary policy decisions that were made over the last year. And so that's why a lot of folks are saying, how much do we need to increase? Shouldn't we let this play out? You have a risk of raising too much and driving the economy into recession, whichever the Fed almost is always the one that finally drives the economy into recession.